Hello and welcome to Investing Confidential, the last Investing Confidential of 2023, maybe ever. Who knows? I'm only seven subscribers away from 1,000. I'd like to get that today, but who the hell knows? Let's get right to it. Last trading day, it's been incredible, right? The S&P just keeps going up. It doesn't stop. It's almost euphoric. I'm going to talk about why next year is going to be the most volatile year for stocks and bonds in the history of the world. Okay, there's no doubt in my mind. It's going to be incredible, and I'm going to go into that in a little bit. But let's look at why this market keeps ripping. And will it rip into 2023? Okay. First of all, as I told, there aren't that many of you, but the ones who've been following me, look, you know that I've been telling you there's no liquidity. Okay. Doesn't take much to get this market higher. The liquidity is gone from the market. Okay. It's been gone for years and years, and the market is easily manipulated. Okay. There's no liquidity anywhere, by the way. There's no liquidity in bonds, no liquidity in anywhere. So it's very simple. You've got terrible data, meaning unreliable data that's being manipulated. And I've talked to you about, I'm not even going to go into it because it's a complete joke. You got no liquidity, and you got the US government, obviously, and Wall Street that wants the market to go higher. Wall Street hasn't done a deal in 18 months to 2 years. They're cutting people left and right. Their traditional business is gone, and they're desperate. So all of their strategists are turned bullish, every single one of them. Believe it or not. I know you believe it, but that's a reality. So they all want this market higher. They're just going to keep buying. S&P higher forever. Okay? I mean, remember the end of 2022. You can remember back then, this time last year, incredibly negative. We had a horrific year, the worst year on record in terms of damage to assets. Okay? A recession was baked in. Inflation was roaring. The war was going on. Inflation, feeding everything. Fed rates higher for longer. Earnings going down. And now we're in end of 2023. Let's look, what is the consensus today? And this is where you need to be really focused on to decide what you're going to do on Tuesday when the market opens, okay? Because it's going to be, a lot of money is going to be made in January, February, March. Trust me. You've got to be active in this market, okay? What's the consensus today? It's bullish. It's euphoric. There's no recession, right, folks? No recession. Soft landing, minimally soft landing. We're gonna ride. We're gonna go higher and higher. Okay. Inflation has been beaten, right? That's what they're telling you. Okay. The Fed's dovish. They're gonna start cutting rates. We want rates to go back to zero. We want fun times again. Okay. The S&P will never go down. NASDAQ, Apple, just keep going up. Stocks are not going down. Okay, and you have to buy everything. You have to buy bonds. You got to buy stocks. This is the consensus today. Everyone is bullish. Positioning, bullish. Very bullish. Not just bullish, very bullish. And as we've discussed, positioning is everything in the short term. But what's the macro reality? Right? What's the macro reality? Well, let's start looking at the macro. This is what's really going on. Okay. First, you look at here. You got leading indicators. Okay, and we're going back, folks. We're going back to the '60s when they started calculating these real leading indicators. And this is look, this is data like everything else. But again, here we are. Every time we have leading indicators at these levels, we go into a recession every single time, without exception. Without exception. So to believe that these indicators are wrong, you have to be insane. Okay? And the reason why I can say that is quite simply, as I've always said, the US economy is a consumer-led economy. So if you're not paying attention to the news, if you're not paying attention to the headlines, if you're just reading the headlines coming out of CNBC, but the real news, here, Nike. I don't know if you saw this a week ago, December 22nd. $2 billion in costs. They had a terrible, terrible year. It's a warning, consumer warning. Guess what? Consumers aren't buying those $300 Nike sneakers anymore. They got problems. Okay, and then now look at FedEx. Okay, again, this is recently. This is a week ago. The stocks were down. The stock was down 12%. Why? Weaker demand. Folks, FedEx is a global lifeblood of any economy, right? Goods and services move, not services, but goods moving around. Okay, online buying. I mean, if this doesn't mean anything, shut the video off. Go home. Just keep buying stocks forever. But the reality is, the consumer in this country is destroyed. Okay, if you're making 250, 300 grand a year, you're in the top 1%. You don't care. But the average person, the 90%, the 95, the 99% is getting hit, and you're being lied to by the politicians and by Wall Street. You're being lied to by your financial advisor. Because here, look at this. I mean, part of the problem here, folks, as you can see here, this is third quarter GDP revision. Okay, revision. This is something that has been happening the entire year. Okay, these numbers come out: GDP, CPI, unemployment. All these numbers come out, and then the following quarter or the month or whatever it is, they get revised. And the inevitable is they're revised lower. So all of these significantly lower. All of these numbers are fake that you're seeing. You're being lied to every time, but the markets keep going up, and no one pays attention to the revision. But look here, consumer spending. This is a consumer economy. How on earth did the GDP in the third quarter, they told you it's 5%, and the consumer has fallen off a cliff? Folks, I'm not making this up. This is real data, right? All the data that comes out is supposed to be skewed positive. Okay, this is a nightmare, and you're being manipulated and lied to by these wizards of Wall Street. And now let's talk about the Fed. Let's talk about inflation. Okay, I mean, the reality is, food and services and a lot of goods like new cars and all this, they have had a massive move since the pandemic, right? Bidenomics and massive inflation. Okay, money pumped through the system. This is what Bidenomics is. It has nothing to do with politics. This is what they said they were going to do. And so all of these things have been ratcheted up. So the cost of putting gas in your car, buying food, has gone higher, significantly higher. And now they're celebrating because the CPI, instead of going up, 4 or 5%, 8%, which it was at one time, is now going up 2.5%. But think about all the inflation we've had, and these goods are trading at certain levels. Those prices aren't going down, folks. They're just going up less. So inflation is still hitting you hard, or hitting the average person hard, not the elites and not Bernanke or Powell, these Fed chairs who never go out and buy and go to the supermarket. They go to restaurants and they don't pay. Someone else pays. Well, they put on a credit card. They don't see it. Wall Street guys don't see it. I'm one of them, okay? But I'm telling you, they don't see it. But that's the reality. So they're telling you that they're raising the flag and happy talk about inflation. Give me a break. Okay? And look, there's no relief. Okay? Look at wages here. Wages have gone up and they continue to go up. That is going to have a negative effect on inflation numbers. But they'll manipulate the numbers. But that's the reality. And by the way, these wages have to go up. Okay, even starting wages, record high. They have to, because these companies these public companies don't pay a living wage in certain industries, in a lot of industries, and they have to. Unions. I mean, look, I never thought I'd say this 10 years ago, but these unions have won higher, they have to win higher wages because the inflation and everything feeds on itself, right? So the wages go up, inflation goes up, but the wages have to go up because inflation's up. And if you don't get a raise, if you're not part of the union or not part of, you're screwed because everything continues to be high. It's going higher at a lower rate, but it is start going higher. Okay. And by the way, that's the bullish backdrop. The Fed's going to cut rates. How's they going to cut rates? Come on, man. As Joe Biden says, come on, man. How are they going to cut rates? How are they going to cut rates? Impossible. Impossible. And then we have market positioning, as we just talked about. Look, folks, the Dow's at all-time highs. The S&P basically just barely missed being at all-time highs. The NASDAQ at all-time highs. Magnificent Seven just keep dusting everything. Okay, here you see, 70% of all stocks have underperformed the S&P. That's the highest ever in decades, probably since the 20s. Or back to the Nifty 50 in the 60s and 70s. 70% of all stocks have underperformed the S&P. As you can see here, it's out of control. That's not healthy. But buy. Everyone's buying. No one cares. Okay? And everyone is bullish. They're the most bullish in decades. In decades. Okay, here's an indicator you're not going to see from anybody else. Okay? Here is call delta. Okay? Now, what is stock delta? Stock delta is basically the potential movement of an option, let's say in this case, a call option, for every $1 move in the stock price. Now, it's a market. It goes up and down, expectations, things. There's a calculation to it. And today, we have the most bullish relating to delta in history. I mean, I don't make this up. That means that call buyers are crazy. There's no put buyers anymore. There's just call buyers, and they've driven up the delta. So there's no value in a call option anymore. There's no value. You buy a call today, you're insane because you are not going to make money. You are not going to make money. Not ever. Retail speculation is out of control. Okay. And here's another, this is from Bank of America. Reliable. Investors are the most bullish in bonds in 15 years. I don't make this up. This is out of control. How could you be bullish on bonds, the most bullish on bonds in 15 years? On a longer term perspective, these rates are still very low. They're going higher over time, but yet people don't give it. They're most bullish in bonds 15 years, I would say ever. Okay, but what's really driving the stock market? Okay, the stock market is driven by buybacks, right? Look, you can't get around it. This whole bull market has been driven by buybacks going back 12 years. And here we have, again, this is something you just can't make up, folks. The largest weekly buyback in history. I mean, forget 2009. This goes back forever. This is insanity. Why is it insanity? Folks, this market was not off very much when these morons started doing their stock buybacks. Okay? And they're financed by Wall Street, right? These buybacks is all leverage, and they've driven stocks to all-time highs. You're not supposed to buy back stock. I'm on the board of some public companies. I will never vote yes on a buyback unless the stock is destroyed and there's some problem, whatever, that the market doesn't see, or the market. Look, you don't buy back stocks at all-time highs. That's not good allocation of capital. But yet we see it. And as you can see here, it's at all-time highs. It makes no sense. This is why, by the way, we have a wealth gap in this country. The wealth gap is the highest since the roaring 20s. It's driven 100% by paper gains in stocks. And this is why. These buybacks have just manipulated the stock market to the point where it doesn't make any sense. It just keeps going up because that's how these guys get paid. The S&P 500 is the reason why we have a wealth gap. And by the way, the S&P 500 is the key to everything in the world. Every economy, every indicator is right now completely leveraged to the S&P 500. Everything. Global real estate, you name it, everything. Nothing else matters. So just buy. This is crazy. And the other reality is, this is driven by the fact that people aren't really buying stocks. They're just buying futures. They're buying options. They're buying indexes. They're buying ETFs. That's it. That's why the average stock is underperforming. As I showed you, 70% of the market's underperforming. And this is why, as you can see here, some of you may own some of these mutual fund clowns. They are clowns. They're index huggers, by the way. They don't buy stocks. They only buy stocks that are in an index. Okay, and they don't look for good companies. They look for good companies within an index only. And so, because of that, they've just underperformed miserably. And because of that, people taking the money out. And I don't blame them. Why would you pay these guys 3-4% when you could buy the S&P 500 ETF SPY and do better with 10 basis points of fees? So these guys are finished unless they change their ways. And we hope, and it looks like maybe they're changing their ways. Because as we discuss, small caps, since this Thanksgiving rally, have significantly outperformed the large caps. Significantly. I think small caps, meaning stock pickers, are coming back into this market. And hopefully, we're going to see more stock pickers. These indexes will decide that they have to start focusing on their core business. And that means that no matter what happens, if you're a stock picker, you should outperform these crazy indexes. Okay? And that's the hope. That's the hope. So in 2024, you want to own, ETF-wise, IWM over the Dow, IWM over the SPY. Okay, and that's the reality. And one thing that dovetails into it, and probably the most important theme for 2024 and beyond, by the way, is the declining dollar. And today, I have to tell you, folks, today something came out, and you probably didn't see it, didn't get much press, but this is the most disturbing news I've seen in quite a long time, and it sort of confirms the fact why gold is going higher, why Bitcoin is going higher, and why you have to get out of the dollar, why you have to be looking at foreign markets and commodities. Here we go. US and Europe are looking to sell Russian assets and give Ukraine the money. Let me explain why that is the worst thing, that only a moron would consider that. A moron. And that's what we have in our government, morons. Needless to say, the Russians, Iranians, everyone have got money in dollars. Got money in US banks, got money in treasuries. That's the reality. Because we've been the currency forever. for as long as as we're alive and for many, many generations. And okay, this money's frozen, like we froze Iran's money. And so we froze some Russian money, but it's their money. It's their money. And to decide, to make a decision, to even think about taking their money, liquidating it, because it's in treasuries most likely, and giving it to the Ukrainians to fund the war. Do you know what the result of that's going to be? Let me tell you what the result that's going to be. That the Chinese, which have already been selling down, the Japanese, all of our supposed partners are going to liquidate their treasury holdings. If these morons get their way, they will liquidate their treasury holdings, which is in the trillions, and they will put their money in gold and everything else. So if this headline is real, I hope it's not. But if this headline is real, it does come to gold is going to go to $5,000 an ounce. Okay, bonds in the US, rates in the US are going to go significantly. They're going to go they're going to blow through 5%. We're going to have a massive problem in this country. Bonds are going to get destroyed. And and the dollar will be wiped out. Wiped out. So this headline, if you haven't seen it, look it up, read the article. This is insanity. These are morons. These are the kind of morons we have in Washington on both sides. Absolute morons. So even though this is probably not going to happen, but if it does, even if it doesn't, the dollar is done. The dollar is toast. Therefore, you need to own commodities. You need to own foreign assets. Okay? And if this is a perfect time, because if you look here, we are the most underweight in a very, very long time in commodities. It's time to buy commodities. And in fact, versus the S&P, right? This is just sentiment, but versus the S&P, we're most underweight commodities in 50 years. Okay? And commodities silently have been in a bull market. They've broken out. But it's just beginning, as you can see, just beginning. The bull market is intact and it's gaining slowly, slowly. But if, again, those headlines I just showed you, it's going to be a nightmare and this commodities are going to rip. So you need to have, as of Tuesday, you need to get exposure to commodities one way or another. Okay, and finally, the last chart I'm going to show you is this one here, where this is the most dangerous chart. One of the most. This tells it all of why you need to be very conservative going into next year. Why probably commodities is going to go up, because we're about to go into the wildest election year globally in history. I mean, look how far this goes back to the 1800s. We got almost 4 billion people. That's roughly 60, 70% of the population of the world are going to be going to the polls and electing people. I mean, starting with Taiwan in January, ending with the US in November. I mean, it's going to be volatile as we've ever seen it. And so therefore, you have to be really cautious, because politics and macro are going to rule everything this year in 2024 coming up. So as we go in, as we end the year at the highs, everyone's bullish. We're going to start on Tuesday fresh. Elections coming up in Taiwan to begin. We got this craziness with Russian assets. Folks, if you're an investor, be very, very, very careful out there.